Oil up again as stocks and bonds continue to sell off.
92,000 jobs lost during the month.
The unemployment rate, wow, really beginning to skyrocket here.
Brent prices up above $80 a barrel. Gas and oil prices are going higher. Shipping rates are going higher.
We've got a new report that shows buying a home has become much more difficult. In 1990, the median home price was $96,000. In 2025, $418,000.
You've been told that a 4% high-yield savings account is the peak of financial responsibility. You see that $1.14 interest payment hit your account every month, and you start acting like you're the next Jordan Belfort.
Hey, fellas! Look what I found in my pocket! Look! A year's salary right here! What I call them? Fun coupons!
In reality, staying with these bank accounts in 2026 is actually a death sentence for your purchasing power. 4% isn't an investment, it's a participation trophy, and you're watching your money expire. Meanwhile, your bank uses it to fund their record profits. Hi, I'm Casey. I've spent the last month investigating these safe but sad interest rates. I'm just tired of seeing our generation's wealth evaporate while we're still waiting 3 to 5 business days for a simple transfer to clear. Seriously, can't be any slower. So, I took matters into my own hands and went hunting for a way out of the 4% trap. While you were busy counting your pennies, I noticed a massive anomaly on the NASDAQ. I found this ticker called STRC or Stretch. It's technically called Variable Rate Series A Perpetual Preferred Stock, but let's be real, I'm not saying that again, so it's going to be Stretch from this point on. Stretch is currently paying a 11.5% annual yield in the form of dividends, paid out every single month. It's designed to give you a S&P-like return without the drawdown, given that it's backed by Bitcoin. But most people hear 11.5% in Bitcoin and immediately assume they're about to get rug pulled, which I don't blame you because I still think about the NFT I bought back in 2022, and I'm still holding it till today. To understand Stretch, you have to go back and understand the man who basically willed it into existence, Michael Saylor. He's an MIT rocket scientist turned billionaire who founded a boring enterprise software company called MicroStrategy back in 1989. Got it? Okay. In August 2022, he had a big brain moment. He realized that sitting on cash was like holding a melting ice cube. Therefore, he pivoted his entire multi-billion-dollar company into the world's first Bitcoin treasury company, now known simply as Strategy Inc. Since then, he accumulated over 761,000 Bitcoin, making his company the largest public holder of Bitcoin on the planet. Logically, I had to ask, why would a guy with billions in Bitcoin bother making Stretch? So I looked into it. My first thought when I saw a Stretch and that 11.5% yield was, this has to be a scam. But why? What I found wasn't a Ponzi scheme, it was a beautiful piece of financial engineering. Unlike the failed crypto platforms of 2022, Stretch is a registered NASDAQ security. It's legit. It actually has audits and total transparency. You can look into it. The yield doesn't come from new users, just like in a Ponzi. It comes from a thing called M&NAV arbitrage. As long as the market values Strategy Inc. higher than the Bitcoin it owns, which it does, the company can print new shares, buy Bitcoin at market price, and then hand you the profit from what they make. It's not magic, it's just Saylor thinking outside the box. Meanwhile, your bank is still trying to figure out how to update their website from 2004. So why does Strategy even want your money? Do they like you? Probably not. From their point of view, Stretch is a refinery. They want to hit 1 million Bitcoin, but they don't want to dilute their common shareholders to get there. Therefore, they created Stretch as an industrial scale vacuum type thing for money or capital. Here's the how it works part. When you buy $100 of Stretch, they usually pair it with $200 of common stock sales. Then they take the sum of that, so $300, and they go shopping for Bitcoin. But what they're doing isn't just buying the dip and hoping for the best. They're effectively running a 3x leverage model. For every $1 that you put into this, there's $3 of Bitcoin backing the system. Your cash goes from your brokerage to the NASDAQ and into a cold storage vault faster than you can send a Venmo. We all know Bitcoin is a mood swing in digital form. If Stretch followed that volatility, it would be a useless savings alternative. It just simply wouldn't work. You can't pay your landlord in vibes when your account drops 20% on a Tuesday.
Rent? Not now. Listen, it's a free country. It's not rent-free country.
Leave me alone.
Give me rent.
You'll get your rent.
When Bitcoin goes up,
Therefore, the company engineered a monthly reset. Think of it as a thermostat for your money. If the price of Stretch dips below $100, the board hikes the dividend to make it attractive so that buyers come back. We saw this in action recently. They bumped the yield to 11.5% just to keep the price at $100 or hugging the par value. The next logical thought would be, but can't they just lower the dividend to zero? No. They can't just erase your dividend yield whenever they want. There is a legal floor protecting you. The dividend can't drop below the SOFR rate, which is currently at 3.67%. And even so, strategy limits how much the dividend can change at every revision. There's a safety net in place. Worst case, you're back to square one, earning roughly 4% interest. Even with all these fancy dividend tricks, what happens if Bitcoin enters a nuclear winter? What happens if the vault value hits the floor and Bitcoin can't recover for a long time? Well, strategy thought of that and they effectively built a fortress around this. They have a $2.25 billion cash reserve sitting in old school T-bills. This reserve isn't just to look rich, but it's specifically designed to pay your dividend for up to 30 months. That's enough time for Bitcoin to recover and for Stretch to survive, even a deep ice age. What this effectively does is it separates your monthly dividend check from the daily volatility of the crypto markets, allowing you to receive a consistent monthly income. When you earn your 4% in a high-yield savings account, the IRS treats it as ordinary income. Basically, the IRS just snatches 30% or more before you even see the notification on your phone. Therefore, your 4% yield is actually more like 2.8% after tax. That is mid at best. But here's how Stretch is different. In the case of Stretch, dividends are classified as return of capital. Essentially, you pay zero taxes when you collect your check today, and instead it lowers the cost basis or the price you paid for Stretch, meaning you deal with the taxman years from now when you finally sell. It's like an interest-free loan from the government to reinvest your own money. You might still think to yourself, well, this is just for degens, but let me tell you, the receipts say otherwise. Recently, on March 11th, 2026, Strive Inc. dumps $50 million of their own corporate treasury into Stretch. They chose Stretch over safe money market funds. And that's just one example. We're seeing record daily volumes of $409 million flowing into Stretch. Vanguard and BlackRock are already stuffing this into their preferred stock ETFs. You could say that smart money has already moved in. Stretch is becoming the benchmark for this entire new digital credit industry, which is no small thing and expected to hit $890 billion by 2030. So let's look at the stats. With a high yield savings account, you have no default risk because it's backed by the government. Your principal is always going to stay the same, but you're losing your money due to inflation. It's a really high risk. In the case of Stretch, it is backed by Bitcoin, so your default risk is essentially tied to Bitcoins and whether it would collapse. Now, principal risk, while it's not zero, it's very minimal, and the dividends help limit the fluctuation to less than 3%. Now, when it comes to inflation risk, that's where Stretch outperforms your high-yield savings account. Inflation risk is low or non-existent, as Bitcoin historically has outperformed almost every investment and outpaces inflation. Now, when it comes to access accessing the cash that you've deposited, Stretch is highly liquid. With the amount of volume of money entering it every single day, withdrawing your money is no issue. Now, a risk to consider is if there was a bank run type situation, this could be a significant risk. In my eyes, I view Stretch as in between a high yield savings account and investing your money into something like the S&P 500 or Bitcoin. With Stretch, you're getting a 3 times greater yield than your high yield savings account, but you're limiting your maximum drawdown from the stock market and Bitcoin. For example, in 2025, the maximum drawdown of the S&P 500 was 19%. Meanwhile, Stretch, your max drawdown was approximately 3%. Another lens to view this from is your high yield savings account is guaranteed money. It's not going to move, and every dollar you put in, you can withdraw. That's great if you're trying to have an emergency fund. But if you're looking for growth and multiplying your money, then something like investing directly into Bitcoin or directly into the S&P 500 is more suited for you. Now, if you're trying to find a high yield with stability and reduced volatility, that's when Stretch is effectively your best option. At the time of recording this, so far this year, the S&P 500 has been down year to date, meaning Stretch has outperformed the S&P. And compared to your high yield savings account, Stretch pays a higher percentage, so it's a way better alternative than letting the majority of your savings rot away due to inflation and rising costs. I want to be clear. You shouldn't put your whole life savings into Stretch. There should be some money set aside in the guaranteed high yield savings account for emergencies and life expenses. But comparing that with no growth to the stock market with immense volatility, Stretch is a great alternative to set some of your savings that you don't need in to juice your returns, but without making you lose sleep at night when Bitcoin is going through a midlife crisis. Thanks for sticking around into this deep dive of Stretch and how it works. Let me know in the comments if you're staying in the 4% friend zone with your bank. I'm Casey, and this was an investigation into your wallet's future. I'll see you in the next one.